Welcome, Investorholics and casual viewers. This is a continuation in the series of investing with the masters. So today I thought we'd have a look at Ray Dalio and his formula for success. And this is some background on his thoughts about getting started in the share market. So Ray Dalio is a renowned investor and founder of the world's largest hedge fund, the Bridgewater Associates. He's been around since the 70s. 1975 exactly. Today his net worth is around $18 billion, according to Forbes anyway, for what it's worth. And as I said, he founded the Bridgewater Associates in his apartment in New York in 1975. So from its founding through to 2017, Bridgewater turned the largest cumulative net worth for a hedge fund ever, according to the data by LCH Investments. So learning how to invest, in general terms can seem like a daunting task. So, we want to be putting our money to work while we sleep, and that's sort of the key step to gaining financial independence and, having a good retirement, or actually being able to build that flexibility into your life to only work when you want to work. So what we're trying to do is develop some smart investment strategies that can be looked at, taking inspiration from Ray and sort of distilled into sort of three sort of little quick sort of steps. So hopefully you guys will get some value out of this, even if it's only one thing you learn. It's definitely well worth hanging around and watching to the end. We'll just try to be as quick as we can and get through it. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. So, in a nutshell, I think the most important thing that Ray talks about is having a savings goal and also questioning yourself. So one thing you need to do is have your goal, and then also when he's talking about questioning yourself, I'd say is measuring. So keep coming back to it and sort of seeing how you go and watch your progress, I should say. So as the story goes, when Ray started working, he was aiming to have 6 months of savings, and that in his mind gave him the freedom and security, and that would sort of help him sort of along the next step. And then his next step was to save enough for a couple of years of freedom and security, and that sort of helped him sort of in his own mind he had the protection for his family then. So you got to sit down and calculate that number. So you have to understand your monthly living costs. So what's the cost to run your house and all your bills, and then that can help you calculate those figures. So if you had to, if you couldn't work, I should say, then this number is the number that will keep you out of trouble for 6 months or 2 years or whatever it happens to be. It gives you the freedom and security in your life, and once you know those numbers and you've achieved those things, it takes a lot of worry out of your life. You can live a bit more stress-free, I should say. So how many months and how many years of freedom and safety do you need, or do you want? They're the things you should be thinking about. So you always need to make sure that you have enough savings, or even more savings than you think you need. I mean, the biggest thing that I didn't realize, or it took me a little while to realize, is that savings for saving's sake actually means nothing. What you've got to understand is, or what the next step is, what do you do with that money? So how do you invest it? Or because you can't just leave it sitting in the bank, because the rates in the bank are so low now. So the average savings account guy must be only getting 0.5% or 1% if you're lucky. So you need to invest your money into a diversified portfolio of assets that increase in value faster than inflation. So, you know, if inflation's 2.5%, 3%, you need to be generating, you know, 5 or 6% to sort of outpace inflation and take account for tax as well, because we all get taxed. So Ray sort of advocates the all-weather type of fund. So he's looking at a portfolio that has 30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, and 7.5% other commodities. So, you know how to diversify into non-cash assets like stocks, bonds, and real estate. And this is what sort of Dalio sort of says. A typical portfolio might be split 50% between bonds and 50% between stocks, but Ray urges diversification, like I sort of described down below. It's a bit wider than that, so you sort of got to look at risk as well. So, I mean, I'm not sure if you guys have read Tony Robbins' book, Money Master the Game, but he kind of interviews a lot of these guys and sort of comes up, and Ray in particular comes up with his all-weather portfolio. And you can also track what Ray's doing with his all-weather portfolio. So you guys can actually see how he's actually investing in semi-real time. You're looking at probably 3 months behind what he does, but I can put that in the next slide as well, so you can sort of see where he's at the moment, to give you guys a bit better understanding of what he actually does, how he works it all. So the mix is intended to do well under any conditions, so the outline just below there. So whether the market is falling or rising. So what pretty much the bonds are there to do are to smooth out the downs, and you've still got the stocks to in the upward market. So in a good market, your bonds are still there to generate your returns, but the large bond component are there to protect you against the downside. Yeah, so all weather. So you're trying to have good returns in all economic conditions. You know, whether the economy is growing or the economy is shrinking. You know, whether it's a recession this year or it's a bull market the year after. This portfolio is designed to do well and minimize downside, but still take some of the upside as well. Representation and what we were talking about on the previous slide, we can see on the left hand side, this is effectively the breakup of Ray's all-weather portfolio. It's not exactly what he uses, but for simplification, this is what he uses. He uses derivatives and other bits and pieces that we shouldn't go near because we're not professionals. So he'll put 30% into the domestic market. We've got long-term bonds there. We can see 40% intermediate term bonds, so sort of 5 to 10-year type instruments, 15%. Then you got general commodities and gold making up the remainder. On the right-hand side here, I've just sort of given you a quick breakdown of what you can do, what's possible. With 6 different ETFs to effectively try to replicate what Ray's done there. So you can sort of set yourself up an all-weather portfolio and just add to it on a monthly basis, $500 every month or whatever you guys want to do. You could set something like this up. I didn't spend a lot of time on researching these to find the 100% best ETFs to do this, but I think this selection here of 6 isn't too bad. So I've kind of chucked in VGS, which is the Vanguard MSCI International Shares Index. So that's a grab-all, so that'll get you some of the best international companies. I've put in 15% for that one. Then I've done VGS, which is the Vanguard Australia Share Index, so focusing on domestic markets. 15% for that, so that's your 30% for domestic, so effectively equities exposure. Then we can see GGOV, so this is probably one of the better ones I could see for long term, so looking for 20-year plus sort of bonds. this one, the GGOV, is the Beta Shares Global Government Bond Plus 20-year ETF. That one's currency hedged, so you don't get the fluctuations in the Australian dollar. I mean, that's kind of taken out of the picture. Probably not a bad one to use. Like I said, I didn't spend a great deal of time, and that was kind of the one that popped out the earliest, I suppose. I didn't have to spend too much time looking at it. Then we've got CRED, which is the Beta Shares Australian Investment Grade Corporate Bond. So that one, you could chuck that in as your 15% for your intermediate type bond. So that'll give you your sort of 5 to 10 year range investment horizon for those bonds. And then we had commodities, which is our light blue one there at 7%. I just put pretty much, the reason I did 7 and 8% there, the only reason it's difference is because I just looked messy trying to do 0.5%, so I just sort of rounded them. So Dalio tends to put more into gold, or he's focusing more on gold right now, so that's why I've kind of sort of rounded that up to 8. So commodities, pretty much, I think Beta Shares, so QCB, Beta Shares Commodities Basket ETF. This is currency hedged, it's synthetic, so it's really just derivatives, so buys and owns derivatives, which I typically don't like, but this is kind of the only ETF on the Australian market I could find that actually does a general commodities basket. So that's like oil and everything else chucked into one ETF. So that's kind of why I put it in there. And then also, you got for your gold allocation, I chose GOLD, which is the ETF's physical gold. Think probably this one's not too bad, or you could also look at QAU, which is the Beta Shares gold, and that's hedged, I think, to the Australian dollar from memory. But these 6 ETFs give you a pretty good overview of what you can do when you're constructing something like this. I think it would probably perform pretty well over time. But like I say, that I spent a half an hour just quickly researching, as a starting point to show you guys what you can do and how you can construct this all-weather portfolio in Australia. That's kind of what I come up with, but as we always do, we always need to make sure we're doing further research on everything that we do. So this is just an example, not a recommendation of any kind. So learn the market's long-term cycles. So this is one of the things that Ray is always talking about. So to understand the market cycles as seen under the financial crisis in 2018 is important. The US markets eventually recovered from the recession and entered the longest bull run in modern financial history, beating the bull run after World War II. And this is in relation to the American stock market. So in the 10 years following the collapse of Lehman Brothers, the S&P 500 increased 130%. So a hypothetical portfolio of 6% stocks. So the portfolio of 6% stocks and 40% bonds returned about 8% over the last 10 years, while returns from interest and savings accounts stayed at record lows, because of all the money printing. So money effectively is not worth that much anymore. So you need to have your savings out. Well, it illustrates that you need to have your savings in other assets and not just sitting in cash in the bank. By understanding historical patterns, investors can avoid missing out on great investment opportunities. So cautious investors that don't risk their money to buy stocks, say after or the 2008 crash, for instance, so they miss out on a chance to earn big returns. So like I say, in the following years, the market went up 130%. That's the total market. So you can imagine there was companies in that total market that went up much more than 130%. So Dalio reckons the biggest mistake that people make is to judge that, try to judge what will be good by what has been good in the past. So if the market has gone up a lot, they think that it's good. It's a good market rather than it actually might be an expensive market. And when it goes down a lot over the last few years. They think it's a bad market, and they don't. Well, they're kind of scared. They're very wary of the market. So it's definitely critical to understand the market cycles and not be scared of the market cycles. So if you're investing, you have to understand the cycles. Like Warren Buffett, Ray says that to know how to buy when everyone else wants to sell, and how to sell when everybody else wants to buy, is the key to great investing. So when everyone's getting in, you're getting out, or you're trimming or whatever, you're reducing your position. So it goes back to the one of the old colloquial sayings, or one of the old the sayings that everyone loves is when blood is in the street, you should be buying, and when there's when everybody else's blood is in the street, you should be buying. So in the down times, that's when the brave investors will actually make their good purchases, and then also once they ride out the downs, and because the market always goes up again, that's when they make their big money and increase their fortunes. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's Crack the Sky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.